Okay. Okay. It's taking me just a minute to get everything going, but it should be going. So I'm in two places. And I'm hoping to get chat confirmation from both places. Uh so if you are in Zoom, hello, welcome. Good to see you. If you don't mind, say hello and let me know that you can see my screen so I know that the Zoom is working. Number two, those of you who are in the uh, stage, the Market Watch stage, is anybody in there? Let's see. Ah, excellent. Okay. Steven said yes, see and hear. Okay, wonderful. We are simulcasting, but not for long. Remember, uh, remember that let me see, can I see who's in my audience? Okay, there we go. Now I can see everybody. Love it. I've got some on the stage. I still have a few in Zoom. Remember, my Zoom users, the hassle and confusion of Zoom will soon be no more. No more changing links from options foundations to trading foundation. No more different links for different days. It's all in Discord. All you have to do, go to Discord. You'll always be able to see the schedule. You'll always be able to join. You see my screen, but nothing's happening, which is, I think, okay. As long as you see the intro slide, that's where I am, just kind of walking through everybody, making sure we're on the same page. Okay, let's dive in. Welcome out, everybody, to the Market Watch Group Options Foundations 2.0. Tuesday nights have been our application sessions. So on Thursday, we talked about diagonal spreads. Now, what's the problem? Well, twofold. Number one, our market is petering out on us here. We've had 2 weeks in a row of a drop, and we said one more week, and now we're really like, okay, what's going on? Right? And so it's teetering for sure right now. We've already seen a couple of weeks pull back. I would still willing to put a bullish trade on. I haven't been stopped out. That's going to happen, right? That's going to happen. As long as you're managing your losses and keeping them small when they come, great. That's just part of it. And now what? Now we're easing up a little bit. Like, okay, what do we have going on here? What is this turning into something more? A lot of times here from November until now, people are like, "Oh, this might not last," and we're like, "I don't know. We're still a 6. We were very positive, but all of a sudden you'll see what happened. We've dropped 2 weeks in a row. We've dropped to a level where it's like one more time, and we think to ourselves, "This is different now. This is different," and that changes things for us. Silence, Bob said. Um, you should be hearing me. You should be hearing me on Discord for sure. So thank you. Thank you, Stephen. Appreciate that. Let's dive in. Let's dive in. Disclaimers. First and foremost, as always, this is for education and illustrative purposes only. We are not advisors. We are not brokers. We do not give guidance. We do not give recommendations. Remember, these are always in your emails. Tonight's agenda, what are we talking about? We're going to do a quick review. This strategy still has applications. But there's a couple of aspects of the market conditions that will cause us to pause, reevaluate whether this is appropriate or not. So two things. Number one is that typically this is going to be a Vega positive strategy. And with the Vega positive strategy, that thought means we would like to do it when we consider implied volatility low. But as you look at our watch list and as you look at the VIX, one of the concerns that we've had, one of our primary concerns, and that has impacted our market posture most severely, was the VIX. And it's definitely inflated, right? So is it still generically low? Anything under 18 is okay low, but is it low where we're thinking we put on Vega positive strategies? I don't think it's that low. That's the thing. So let's remember that right now, our thought with this strategy is definitely more, let's learn it and maybe let's paper trade it. Absolutely, there would be minimal cases where I would say, yeah, this is probably the best scenario. I found a scenario in our watch list where this strategy does make sense, and I'll explain why. And that's the one we're going to use as an example in order to construct this today. So questions, you can send them either channel. We're gonna go at least this week, maybe one more to give you the chance. I'll be sending out, for those of you who are not on Discord, I will be sending out invites regularly with the link and the instructions so that you can get in there, get familiarized. It's not just, hey, this is better for accessing these webinars. This platform is a substantial feature that, as we get increased adoption and usage, you will find that you are leveraging the strength of the group through this channel. So forcing you to come on here in order to participate and watch these presentations is kind of my way to say, hey, this thing can be magnificent. And if all it does for you is make it easier to get in and watch these and not have to have all these links and remember the calendar because you can always pop in, perfect. But I promise you this, as you look at some of the channels we're creating, some of the discussions we're looking to have, you're going to see that this is right in line with how you can really leverage everything that we have to offer as a community. Okay. Changed browsers and can now hear. Now here's the other thing, right? For a lot of us, this is a new platform. And so we're kind of, us early pioneers in this are learning together. So certainly, for example, I learned yesterday that the event doesn't start itself. I have to go start it. So if anyone went in the morning and couldn't get in, lesson learned. Okay, chalk it up to experience. Onward and upward. We will work together to make this the best it can be. So if you're out there thinking to yourselves, man, it sure would be nice if yada, 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 take that yada, yada, yada and send it my way so that I can assimilate it and, figure out what's the best way for us all to do this. All right. What are we doing today? Quick review. What are diagonal spreads? So we'll go through and we'll talk about diagonal spreads. Then we're going to go to the model and we're going to build a diagonal spread. And then we're going to have some Q&A. Again, questions can come either way. Let's go dive in. Let me move this out of the way. Okay. Nope, that's not what I meant to do. Let me restart that presentation. Sorry. Let's restart that. Let's switch this across. And what are diagonal spreads? Let me just bring my Discord back up. Lost my screen. Can you see my screen now? Yes. Okay. Beautiful. What are diagonal spreads? Diagonal spreads are a subvariant of time spreads, which involve the simultaneous purchase and sale, like any combination we've been talking about. But in this case, we're now using different strike prices and different expiration dates. We started off with different strike prices, same expiration dates. Those are verticals. Then we went to same strike prices, different expirations. Those are calendar spreads or horizontals. Now we are finishing this geometrical pattern with diagonal spreads. Paul says, yes, but very small. Okay, so Paul, look around in your screen box and you should see a little like a frame that allows you to like pop it out and maximize it, and then it becomes like a full screen. There should be some sort of full screen option. And Steven's trying to give some advice as well. Click on the presentation. Yes, love it. People helping people. Beautiful, beautiful. Okay, different strikes, different expirations. What's the purpose? This is a hybrid approach. We are combining the principles of time decay, which is what we get from calendar spreads, to the principle of directional trading, which is what we get from verticals. And so we kind of put them together. So if the trade stays where it is or only moves up a little bit, it behaves more like a calendar spread. If it moves bullishly, then we still have more directional potential. Now, there are times where you can construct this, where it makes money no matter how high it goes. I would actually say that a broken wing butterfly does a better job of that. But when it comes to a diagonal spread, we're typically going to do this on stocks that are bullish, right? Bullish, slowly, steadily bullish. That's a great candidate for a diagonal spread. And the reason why is because if you're wildly bullish, you can definitely, if you're thinking it's going to make a big move, you can make more money with a different strategy. If you think it's not going to go anywhere, you can make money with a different strategy. If you think this has a nice, steady trend. So there's times where I'll put this on the market, on a index-based ETF, just simply as part of my market posture. I'm slightly bullish, volatility's low. Great, what should I do? Diagonal spread, put it on, ride it, keep adjusting it, keep extending it, and we have the ability, when we assess a trend, to place the diagonal spread so that it works in the context of the path of that trend. I'll show you what I mean when we go look at a specific example. The purpose in trading, additionally, sorry, I think I went through that. Traders use them to capitalize on both time decay and price movement while managing risk and cost. And that's the other thing. Remember, this is going to be a debit spread. Can't lose more than you put into the trade. It's going to be very similar to how a covered call would work. But with a covered call, you have a substantially higher capital requirement. If you're going to trade a covered call, then for every 100 shares you want to sell, you need, or for every one covered call you want to sell, you need to have 100 shares of stock. What do I need here? Well, I'm selling the same call. What am I selling? Short-term call. But instead of buying the stock, what am I buying? I'm buying 2 or 3 months, slightly in the money, call option. Substantially less capital than buying the stock itself. What am I selling? anywhere from 2 to 4 weeks, slightly out of the money. Doesn't matter whether I buy the stock or buy that option, I'm selling the same thing. So now if I'm collecting $1 premium, well, if I get $1 premium on a $40 stock, that's 2.5%. If I get $1 premium on a $7 option, that's substantially higher now, right? Now it's 15%. So I'm very similar thought process as the covered call, but it's leveraged in that regard. You'll hear people sometimes be like, it's like covered call on steroids, which is just kind of a little dramatic. It's a leveraged situation in that regard. So what's the importance? When you expect a bullish trend, we can put this strategy on to have a directional bias. We can have time decay working in our favor. We can have price working in our favor. And the last thing that we have, so we said this works well in a low implied volatility environment. If that low implied volatility environment ever reversed, what happens to volatility? It spikes. What did we say the vega tends to be on a diagonal spread? Positive vega. If volatility is shooting up and we have a positive vega, that's actually pumping value in. So that when we look at, hey, this is where I'm wrong, and we assess how much we're going to lose, we actually would need to do a bit of a vega adjustment. Again, these are the things we're going to go look at here in just a moment. In order to see, hey, how would this actually help us if the stock went against us? Okay, real quickly, the construction, the logistics, again, different strikes, different expirations. What's the tendency? I'm going to blend selling a short-term option that's a little out of the money with buying now, long-term is qualified. Long-term to me, maybe 2 months. I sell 2 or 3 weeks out of the money and I buy 2 months, and that's it. I'm moving pretty quickly. Some people do this strategy using LEAPs. Remember, long-term equity anticipation securities, LEAPs. What are they? Usually it's an option with a year or more. You don't have to. So long simply means that one is longer than the other in that regard from a duration, not long and short, meaning I shorted the closer duration and I bought or took a long position in the further dated position. However, you need to break it down so that you're connecting what you're doing here, buying a little more in the money and a little bit further out in time, selling at or out of the money for short periods of time, right? Because I can sell it 2 weeks later. If nothing happens, it expires. What do? Sell it again. 2 weeks later, what do? Sell it again. If I can keep selling it, and if it's moving up gradually, I might be able to keep selling my strikes a little higher and a little higher. So all the while, if the stock's moving up a little bit, my long option is making money. And along the way, I'm collecting these little pops. Sell it for 2 weeks, buy it back cheap, or let it expire worthless. So, right? And that's the thought process here. A combination of growth potential that we get from buying the longer term, slightly in the money option, or whatever longer term means to you, versus the income potential created by selling the short-term options. And you can do it over and over multiple times. Choose an underlying asset. We want stability to maximize the advantages of time decay and potential directional movements, right? I don't want, I still need to use drawing tool. Okay. I don't want something like this. I want something like this. Right? If I see this and I'm going to try to catch it, I'm going to try to catch these swings. Wait for it and catch the swing. Wait for it. Here, my thought is, hey, I can put this thing on down here And then I can look to basically hold options from here to here. And then I short it from here to here, right? And anytime it looks like it's topping out, I put on a short for 7 to 10 days. And then when it starts to turn back up, I take it off. We can leg in and out. We have a lot of different ways to manage this, but essentially this behaves like a covered call. So let me know if any of that's not clear. If you have questions, let me know now because we're about to dive into the model. Expiration dates, we're staggering it. Like I said, for me, I'm going to sell 2 to 3 weeks. I'm going to buy maybe 2 months. And I will try to work that for maybe I'd say probably 2 to 3 opportunities is what I would look for as a potential, either holding on to it or get out of it, get back in, get out of it, get back in, and try to move it a couple of times. Managing these. What are we looking for? We're looking for the option you sold to lose money faster than the one that you bought and possibly expire worthless. And then you can do it again. Or we can roll the positions, which means if it gets to a point where the option I sold is only worth 10, 15 cents, let's say I sold it for $1, now it's worth 10 cents. Great. Buy it back for 10 cents and sell one somewhere else for another $1. A week out, a little higher, whatever you need to do, that's rolling it. You're rolling it for a credit. You buy back for 10, you sell for 90, you got an 80-cent credit. That's money in the bank. You're booking that, right? You're booking that gain every time you do that type of a roll. Or at any given time, you might get to a point where you say, hey, I've reached a good gain. I'm not as sure about the market posture. Now I can close the entire position. Again, with spreads, that's one of the advantages is, there's a lot of different things we can do. They don't move quickly so that they're like forcing you to make a decision. I've got to do something now. You have time to reflect and say, okay, now what? What can I do with this? Okay, no one's asking questions, so I think it's making sense. Let's go to the model. Today's candidate, I'm going to use, surprisingly to me, NVIDIA. Let's pop in there. Why do I say NVIDIA? And you might think, oh, it's so strong. I mean, it is. It is very strong, but you can see that it's slowing down now. It had such a strong move. A lot of AI has even reversed more than this. This one has eased up, but it's also still holding holding the 50, above the 50. Now, right now it's pulling back a little bit. I'd want to be a little bit more certain that it's at or near maybe bouncing off of support rather than pulling back. Right now, we may be coming down to test this, and if it holds and bounces, that's when we might think, especially you can see here, if the volatility holds. There's a lot of other candidates right now that still look somewhat bullish. Sometimes I feel like it can be sneaky, but if you look at it, just like you look at Apple, bam, look at that vol. All of a sudden, it's at the top. AIG, you look at the vol, it's at the top. AMDN, where's the vol? It's at the top. And that's a little concerning to us. Like, there's just more expectations built in. So, yeah, I'm looking at that like, oof. The market's pricing something in Amazon. If Amazon was low vol, like back here, I'll tell you, right, if you would have done a diagonal spread, and this would have been a great candidate in either of these areas, as it looks like it's bouncing out of this, but it had slowed down. Same thing back here when the vol is low. When the vol's up here, diagonal spread's no good. Down below, now we're talking. And you can see that in this situation, if over the course of time that you're in this trade, if over the next, let's say 6 weeks, what happens? You can see that the stock went from 148 up here near 160. That's not actually a huge move. It's 12 points, 7% over that period of time, but it was bullish. And what did the volatility do? The volatility went up during that time. Diagonal spreads would be phenomenally successful. Same thing over here. In either of these, what's happened? Stock prices moved up, like super strong? No. No, it hasn't been outrageously strong. Strong enough, volatility has risen. So, what kinds of stocks make sense for this? Grinders, we call them. Grinders. Sometimes I'll be honest, I sometimes shy away from them. I'm like, I want things that can move, but the things that can move can actually be the things that also frustrate us, right? So I'm hearing chat come in. Let me go make sure that I'm caught up on it. Uh, can you use Finviz to find low vol candidates? No, I no, not unless they have something new. What you can do, however, is use you can actually just use Think or Swim. So if you look here, let me move this over. This is my watch list here, my market watch list with everything in it. And you can see one of the things I've added. Let me see if I can make this a little bigger. Let's move. Here we go. One of the things I added here was vol index. So I could come in and I can sort it so that I can say, okay, who's down low overall in their volatility right now? We say, oh, it's the SPY. It's pretty low relative, right? Because, although I don't know, is it? Yeah, see, I don't know. I think the vol index is a year. That's where you maybe get a little run up. Uh, Even that, I don't see. Oof. See, I don't know. I'm feeling a little like these are not that low. I don't feel like any of these are that low. You know what? Yeah, I'm gonna have to look. I'm gonna have to see what's going. There you go. VIX, no. SMCI is at the high. 97. Oh, you know what? Sorry, I put the wrong thing in here, actually. I don't want the vol index. I want I think I can put let me see here. Vol. I'm gonna have to play at that. Yeah, there's a way we can do it in Thinkorswim. I'll show you that another time. Let's get into the diagonals. Unfortunately, most of the scenarios that we're looking at right now are high implied volatility scenarios. So you can actually add any indicator, and then you can sort by where it is on that. That's the kind of thing we're looking for, like chart questions. Tuesdays and Thursdays in May are going to be we're going to have workshops. May is workshop month. Those are the kinds of things that we can look to do. I've already got a few ideas that we're going to do that'll be extremely educational and real hands-on, like so we can really wrap up some concepts. Okay. So what are we doing here? Let's get back to 6-month daily. Let's get back to let me sort this again. NVIDIA. Okay, so we're just gonna kind of assume, yes, we like this. This is what's gonna happen. I am going to come in here and go to NVIDIA. What am I on here? What is going? There we go. Okay. Okay, now we're going to go to add simulated trades. You're going to go in here to a diagonal spread. Okay, now for me, I'm actually going to, like I said, I'm tending to go 2 weeks to 3 weeks out. So right now I would probably go to May the 3rd. Then I would skip May and go to June for the option that I'm buying. Right? So I'm buying about, well, we can look at it here. So let's scroll down. Let me get these drawing tools out of the way. Let's go here to May 3rd. And remember I said we're going to go a little bit out of the money. So how would I determine something like that? So for us here, we're thinking to ourselves, let's create some sort of a path. I'm going to put some drawings out here. Nope, I'm actually going to do a channel. So I'm going to come across the bottom of this and just kind of see, okay, so if we go like that, and we say that it got a little hot there for a little bit, but not by too much. If we say this is our path, and let me give myself a little bit more time. So let's go out 20 days to extend this thing a little further. And I'm going to extend these drawings to the right. Also going to pull this down a little bit. So what am I thinking over the next, now remember, May 3rd is here, right? May 3rd is here. So let's draw that line in. Where is it? Here. Nope. I thought I could cheat. There we will go right there. Is that right? Close. 1 day off. Okay, so we're thinking in this range, where are we going to end up? Well, low end, I would say. What does that put us at about? Maybe 940. High end, so somewhere between about 940 and 1,050. So if I just kind of thought to myself somewhere in the middle there, right? We could kind of say, where do we think this thing might end up? I'm probably going to go towards the lower end, actually. I'm going to say like 920, 925, something like that. So let's go back to, and I'm going to sell 925, but I'm going to buy, we said a little in the money. Let's go 860. Okay, now, this is NVIDIA, mind you. This is a $900, $875 stock. If you did a covered call on NVIDIA, you would have to pay $87,000. And then that would buy you 100 shares. Then you could sell one contract. You can see here, if I do one diagonal spread in this regard, I mean, it's still sizable. I'm still paying 3,300. So is this a strategy that like, oh yeah, you can just throw it on there? No, it's if it wasn't a $900 stock, certainly it's going to be a lot easier, right? But does it 3,300 seem reasonable to trade into NVIDIA that is a $900 stock that a lot of people feel like there's no way I can trade into this thing? I would say, yeah, right? Like that's one of the advantages that this gives us is that type of a capacity. Is there any worries about which one you buy first? It really doesn't matter as long as you end up buying the one that is actually, look, I didn't go far enough out. Sorry. You know what? I actually said I'm probably going to go, maybe it's going to get a lot more expensive, actually. That's my fault. A lot more expensive. Why? Because I wanted to go a little further out in time Still, this is about 10-to-1 leverage on a covered call. I wish I could have shown a more reasonably priced example. I think the only other worst stock I have would have been Chipotle, which is a $3,200 stock. But this is certainly one of the ways that you would consider this. If you like covered calls and you felt like there's no way I could ever do a covered call in NVIDIA, well, this might make this more reasonably attainable. Instead of an $86,000 strategy, it's an $8,600 strategy. But no, there is no, I'm glad you brought that up, Sandy, because that pointed out the fact that I had forgotten to adjust the second expiration. Here's what I want to point out to you. Let's do a quick Greek assessment. Remember our three main Greeks. Delta, direction. Our direction is positive, bullish delta. We want this thing to go up. Theta. Now this is just one contract. What is our theta? We are theta positive. As long as this thing stays on, we keep making $32 a day in time. And what's the last? Vega. We are Vega positive. Remember what I said. That's why we have to do this when implied volatility is low. If we do this strategy when implied volatility low, this is an advantage. If we do it when implied volatility is high, it absolutely switches up and becomes a disadvantage. So as of right now, what would my thought be for this stock? I'm bullish. I want to make money from time decay because it's kind of a steady stock. And I get it. You're like NVIDIA, steady. I'm thinking now that it went through that big move and it's kind of settling in. Okay, that's the thought. When it rises during the trade, is that an advantage? Yes. So for example, right, we looked at a couple where the implied volatility went up. This is what it looks like. So let's remove this. Let's go into this risk profile. So here it is. Now, this is a directional trade. So I still need to have a, this is where I'm wrong thought process. So I might look at this and say, you know what? If it breaks below 800, let's say 790 or so, that's breaking the 50-day. That's breaking, that's kind of getting down here. Maybe even we say 785. I don't know. Let's spitball something. Well, that's pretty far actually. Maybe I wouldn't let it go that far. Maybe I wouldn't let it break this low. Yeah, let's go more like 820. I mean, it's 875. That's a pretty good drop. Let's go 820. I think I was being a little too generous there. So let's say 820, maybe even 825. Let's go 825. Okay. So there's my risk level there. Now, you can see there is a point. Remember that this point right here, right around, actually, I missed it. Let's put it right at 855. This point at 855, that's where time goes from positive to negative. You can actually watch it happen. So keep your eye on this theta box right here. I'm going to move this line. And as this is, let's just assume this is the live price because that's what this represents. And you get in this trade and the stock is dropping and it's dropping and it's dropping and it's dropping. Now you're losing money because theta or delta is working against you. Delta is working against you. We haven't shown what theta is doing during this time. And time, is time where delta is working against you, time's working for you, you're losing money. If you notice, right as we get down near this, it actually is lasting longer than I thought. We have a little ways. It's not right at the cross. We have a little ways, which is good for us. By the time it gets down to our stop loss, that's right when it starts to turn negative, right around 8:30, and then it starts to get worse. That's today. As time goes on, it gets worse and worse. So now that's time. That's time. Now you can see as direction moves, as we go here, we're moving up. And we get up into this area, and this is where things sort of stall out. Where do they stall out? Somewhere around 960 to 980. When it gets to 960 to 980, we don't really make much more money this way. So we kind of think, yeah, that's it. Somewhere between 950 and 990. And we go back and we look at the chart and we say 950, which is here, to 990. Whoops. That's not what I wanted to do. What did I just do? So at 950, right through here, remember May 3rd. May 3rd is here. Yeah, 950 to 980 is right in this zone. So if this thing just moves on up into that path, beautiful. What if it goes too far? What if it goes all the way to 1,000? What if it goes all the way to 1,040? Well, you can see here's 1,000. And if you look at that purple line, it's actually just kind of straight. Same amount of money, still making that much money. And if it keeps going, still making the same amount. So basically, no matter where it goes up here, I've got a great probability for that. Right? So that's where, now, if you notice, as time ticks in my favor, you can see that this purple line just keeps getting better and better and better and better and better and better. By the time we get towards 2 weeks, you can see I'm at May 1st. At May 1st, anywhere from 900, there's 900. We're making about $1,500. That's at 900. All the way out here to 1,020, we're making about 1,400. So anywhere from 900 to 1,020. So now we go back and we look at our chart on May 2nd. So here's May 2nd right here. So from 900, which is actually down here underneath this channel, even if it fell a little short, as long as it moves up by about 25 points, 25 points. Now, if it doesn't, we're still going to be okay, right? But 25 points. So as long as it just sort of goes sideways and slightly higher, anywhere from that 900 level all the way up here to 1,040. So essentially what we've done is we've built this entire range so that if it just lands at that point on its way up, boom. And then what? And then we buy back the 925 and sell the 950, or then we have something else that we can do in order to make this trade then give us another 2 weeks, right? And then another 2 weeks. And if we go from 925 to 950 and then 950 to 975 and then 975 to 1,000, then by the time we're done with this trade, we've paid down this $86 debit down to like $40. And the trade is now worth $160, right? And so just when we have these slow, steady trades where you're just like, a lot of times I pass them over because they're not as exciting for swing trading. But I'll tell you what, now that we've introduced this concept, those are on the table for us to say, hey, do we always, think about this. Do you always want your trading to rely on in and out and fast and ride it and swing it, or sometimes is it nice to just put something on, sit back and let it do its thing? It's not going to move fast. It's just going to, time's on our side. Now, the other question is this: what about vol? We saw quite a few that as the stock went up, the vol went up. Okay, so let's pull that out. Let's move this back to the other side. Okay, so now let's go back. We'll go back to a week from now. Go to the 24th. Won't it get exercised if it's much above 925? I wouldn't expect that it does. No. No, just because it's in the money. Now, if there's a dividend, maybe. And as you get closer to expiration, maybe. But just because something's in the, right? So how many times when something's been in the money have you exercised because it was in the money? most people aren't buying calls to buy stock, right? It's when they have to because of dividends and things like that, that there's a greater incidence. So can it happen? Yes. Is it likely to happen? No. That's how I would describe. Great question. Great question. Last variable, volatility. Now, when we look at something like Caterpillar. That's not Caterpillar. Caterpillar went from 24 vol up here to 36. That's 12%. We saw others that did even more than that, I would say. We went from 24 to 38, 14. So let's just say 10% volatility. Now, let me erase this. When we do a time calculation, when we're manipulating this here, you're only watching the purple line, right? But when I start manipulating volatility, it actually influences both. So let's just go 1% at a time, and let's put a mark right here around 9:45, and yeah, we'll put this up at 1,020. We'll put this at 9:45, and we'll put this down at our stop, because let's say even down at our stop at 8:25, we would expect vol to go up if that got down to that point, right? So if I have 1% in vol, you can see what's happening, right? 14, 16, 18. So what's going to happen? I think 14 is going to keep going higher. 16 is going to go higher. 18 is going to go lower. Next 1%. 14, 16 became 16, 18, or close to it. And 18 dropped to 16. If I get another 1%, you can see it's just pumping value in, getting more down on the downside, right? So let's keep cranking it up. Let's get to 4. This is why we want vol to be low when we start this strategy, is that we want that vol pumping in. If we even get 4%, we're talking about getting 12 to 14. We're only going to go up to 10 at 4. Look at the difference. At 5, we're up to $2,000 winning, down to 1,200 losing. Now the down one is most important, because if it dropped to that level, we will get this right here. So we're down to 1,100 loss, 975, 825, 700, bam, 575. If we get 10% vol pumping in as this thing dropped against us, it sustains the trade. It's pumping value into the option you own at a faster rate than it's going out of the option that you sold. And the net result is you come away better, right? Where we may only lose somewhere between $500 and $1,000 on the downside by the time we get out of this thing, dropping all the way to 825. But if it goes up, if it goes up and we get implied volatility, fabulous. We get $2,500. And the longer it goes, the better off we are, right? We get more and more. Even if we don't get the vol, even if we only get 2% vol to the upside, we're still getting 1,600, 2,300, and our loss is only like 500 to 1,000. The hard thing is it's very difficult to quantify reward to risk without really like having a strong sense of what it is you're trading for, what it is that would have you stop out, and how you're expecting to calculate that. So hopefully you kind of have a better sense. Like, this is a 2-week trade. if in 2 weeks, what stock was I on? I'm so bad in memory. You're like, really, Scott? You forgot that we were on NVIDIA? Yes. Don't. It's a real problem. So the thought process is that somewhere in this vicinity, I have this range right here. So if this thing goes like this and then pops up right at the end, I'm fine. If it goes up hard and then goes sideways like it did back here, I'm fine. If we end up in that range in 2 weeks, what if we end up straight across? Yeah, if we end up straight across, that means that at some point, well, we end up straight across, time's going to start working. Whoops, sorry about that. Time is going to start working against me. Where did I go? There we go. Yeah, if it goes straight across where we are at 875. Actually, if it goes straight across at 875, we still make money. We have all the way from where we are now, we have until about 862. 862. This is our break-even zone. So I would say let's get this drawing tool back. And it's really about like right here. That's our max profit zone. So we don't make as much. If it only goes up a little, if it stays where it is or goes up a little, you make a little bit of money. It can actually go down from where it is. Sorry, it can go down. If we're at 874, it's down here a little even further. Yeah. Anyway, there you go. Diagonal spread. What am I looking for? Strong, steady stocks, low implied volatility. Grinders, where you think, yeah, I'm really having a hard time finding entries and exits. Great, diagonal spread. Put it on, let it sit. You're working premium, right? As long as it moves in whoops, this type of a fashion. Essentially, when you put this on, you have this. And if it stays inside of that range, great. You're in a good spot. Okay. I got questions coming in. I hear them coming in. Let me get my Discord back up. So it's kind of a conditional intercept, covered for a range of price. Yeah, that's it. If you're straight neutral, there's something better. You're more directional, but if it happens to go neutral, you'll be okay. It's not ideal. It's okay, right? You make money if it goes down a little. You make money if it goes sideways. If it goes up a little bit to even a lot, I mean, a lot is still covered, right? This thing would really have to skyrocket in 2 weeks for it to move where you're losing money. Let me show you what that looks like real fast, because this is absolutely a probability trade. This thing would have to drop below 1140 before you would lose money. I mean, it could get up here to 1110 and you're still going to make a couple $100 on it. 1110, that's up here. And we're saying it would have to get there by this point. Like it would have to be like just shoot straight up and then just not recover. This is a probability trade. How often do you use them compared to other types? I would say I would have 1 or 2 of these on at any given time during a low volatility bullish market. Yeah. A couple of these on. We have our risk managed, times on our side, because what is this going to give me? It's going to give me positive delta. It's going to give me positive theta, and I'm going to need that in this type of a market. And again, positive vega. So it gives me the hedge. If this thing dropped against me, the swell and the volatility is going to help sustain until I can close the trade. How do I pick the stock? Yeah, low IV, solid trend, low IV. Essentially, I wish I could go back in time now. Anytime I say, oh, that's a grinder, that's hard to find an entry, I'm looking at that from a swing perspective, right? I'm like, oh, that's hard to find a swing entry. this is less reliant on swing entries. This is about time. This is about probability. So this is less reliant on that. I mean, we still want to be somewhat, similar directional concerns, meaning I would rather catch a bounce off of support than a bounce off of resistance for a bullish trade, of course. But essentially, that's what I'm looking for. Bullish stock, low IB, not heavy swings, but in a nice, steady climb. Not sexy or exciting, but steady and more reliable. Love it. That's exactly right. That is exactly right. So is there a place for these right now? Less so. Less so because we're a little concerned that the vol is swollen up on us, right? But if we see this market settle and resume its bullishness and that vol bleeds out, these are going to be strategies you're like, yeah, because that's the thing. If all you ever do is swing trade, it's very difficult. Very difficult to get your money working for you, right? We need the calendars and the diagonals because if you're just constantly waiting for swings, it's like sitting in traffic all the time, right? We need to have some steady things that we put on, and they just sort of that's diversification by strategy, and I absolutely counsel for that. Thank you, Phil. I appreciate that. Added the implied vol to the watch list. Works good. Awesome. Love it. Thank you. Sandy says these are me all the way. I think that's what we have to do. Find our fit. Right? Which of these? I'm not trying to advocate that you're doing someone. I think you're going to find 2 or 3 core option strategies that fit you, and you're going to do them over and over and over. I'm about out of time, so I'm going to leave you with a quote from the late, great, legendary Bruce Lee. He said, I don't fear the man who practices 1,000 kicks one time. I fear the man who practices one kick 1,000 times. So, yeah, I don't want to be like kind of good at 15 different option strategies. I want to be damn good at 2 or 3 option strategies. That's what I want for you. Anyways, give us some alerts, please. Bob said, done. When that vol eases a little bit, which I'm now, we may be finding ourselves moving into a correction. And if that's the case, if it's a little early in the summer, great, we adjust. Absolutely. Thank you, Sandy. I appreciate that. Time to go play. Time to go paper trade. No, okay. Bob said, now what? Let me get back to my slides real quickly. Where did my slides go? Oh, I think I canceled them. Hold on. Let me finish up here. Boom. And what's next? Advanced combination spreads, which means what? Butterflies, iron condors. Butterflies, iron condors. These are actually going to come into play now and possibly for the next few months. Why? Because they are Vega negative strategies. We want to put them on when volatility is higher. Where do we see a lot of vol? High. High. So if we think, oh, these things are just going to grind sideways, and you might think, well, what if it doesn't grind sideways? What if I put it on and it drops? Then you put another one on because, yeah, we can build these things with like blocks, like building blocks. Love it. Don't miss it. Thursday, advanced combination spreads. Tomorrow we have a couple of events. We'll have our typical morning. If you can get onto Discord, join me on Discord. Let's make it happen from there. If not, we'll still be doing Zoom. I'll still be sending out regular intervals of Discord instructions and link to get everybody on there, because we are going to sunset the Zoom interface and interaction. I think we'll all be a lot happier when that happens. Okay. Amazing. It's great to see everybody. Thanks for coming out, hanging out with me tonight. Also, you missed Stephen and I had a nice little chat, hanging out. He wasn't drinking. I had a cocktail. If it's cocktail hour, I'm coming with a cocktail. I found what I could in the house. Monday. I promise you, you're going to like that session where we can just sort of mingle and talk and a little bit of market talk, but it's a little more social and just lets you kind of unwind and relax. But it's going to be a great session. Build the community. Let's get to know each other a little bit. Monday. Oh, you did have your drink? My bad. Mocktails for the non-drinkers, Sandy said. Fair enough. Fair enough. If it's ice water, I understand. You know, but I want to see everybody there next Monday. We're going to try it again. I want everybody there. Okay. I got to run. It's good to see you all. Have a wonderful rest of your night. I'll see you tomorrow. I love diagonal spreads as always. Happy trading.